Namaste and a very warm welcome to all of you. Today, we've got a very special explainer lined up. We're going to look at a document called Indian Accounting Standard 24, or IND AS 24 for short. It's titled Related Party Disclosures. Now, I know, that sounds like a very heavy technical topic, but honestly, please don't worry at all. We're going to take a very relaxed, friendly pace today. We'll translate this complex accounting rule into simple terms that any common man can easily grasp. So, sit back, relax, and let's learn this together.
So let's just dive right into a very relatable problem. When you invest your hard-earned savings into a company, or even when you just buy goods from them, how do you really know if the company is making fair, honest deals in the open market? Like, what if the management is secretly giving sweetheart deals to the owner's relatives, or maybe selling things super cheaply to a friend's business? Well, this is exactly the problem that IND AS 24 tries to solve. It's all about bringing the real truth out into the open.
Here's our quick roadmap for today's explainer. First, the core objective. Second, understanding related parties. Third, the disclosure rules. Fourth, government and privacy exemptions. And finally, differences from global rules. Let's get to it. Section 1, the core objective, and why this standard actually exists. To really understand why we need this rule, let's look at its main goal. The objective of IND AS 24 is simply to show the public if a company's financial health and its profits are being secretly influenced by the people pulling the strings behind the scenes. Look at the difference here, using a classic example right from the standard. In a normal transaction, a company sells goods to a total stranger, right? And they charge a price that makes a good, solid market profit. That's just normal business. But in a related party transaction, the company might sell those exact same goods to its own parent company right at the cost price, making absolutely zero profit. I mean, they would never give that kind of deal to a stranger. So this shows us exactly why we need to know about these hidden relationships. And it's not just about selling goods at a cheaper price. Sometimes, just having the relationship can change how a business acts, even if no money changes hands at all. For example, a parent company might buy a new business and suddenly order its subsidiary to terminate an old trading partner just to favor the new one. Or imagine a parent company instructing a subsidiary to stop doing important research and development. That completely changes the future risks and opportunities for everyday investors like you and me, which is exactly why these relationships must be brought into the light. Moving on to Section 2, understanding related parties, or who exactly are we talking about here?
Now, the standard has a lot of dense legal definitions, but let's just translate them into simple English. Naturally, family members are right at the top of the list. If a person has control or influence over a company, their close family is also considered a related party. But what's really unique about the Indian context here is the inclusion of the extended family. While global rules talk mostly about spouses and children, our Indian rules specifically add brothers, sisters, fathers, and mothers to the list of people who could influence a deal. In our culture, the joint family influence is very real, and the rules beautifully acknowledge this fact.
Besides family, the standard talks about key management personnel. Let's break down that corporate jargon. It really just means the top bosses, anyone who has the actual authority and responsibility to plan, direct, and control what the company does is a key management person. This includes any director of the company, whether they work in the office every single day or not. Naturally, these top bosses are related parties to the company they run. And because these bosses are related parties, the company must tell the public exactly how much they are paying them. But compensation isn't just the basic monthly salary. The standard makes this very clear. Compensation includes absolutely all forms of payment. We're talking basic wages, paid sick leave, retirement pensions, long service leave, bonuses, and even payments made in the form of company shares. Every single benefit must be added up and shown transparently to the public. But it's just as important to understand who is not a related party. The crucial point here is that just because you depend on someone for your business, it doesn't automatically make them a related party. For example, a bank provides finance, but they're not a related party. Trade unions, public utilities, or even a massive customer that buys a ton of your goods, they are just doing normal business with you. Also, two companies aren't related simply because they happen to share one common director. The standard draws a very sensible and clear line right there. Okay, let's look at Section 3, the disclosure rules, essentially what companies must tell the public. Now that we know who the related parties actually are, what exactly is a company forced to show us, the common people, in their published financial statements? Well, the most basic rule is about control. A company must always
always disclose the relationship between a parent company and its subsidiaries. And here's the really important catch. They must declare this relationship even if 0 transactions happen between them during the year. Why? Because the power of control is so strong that just knowing the parent company exists helps the public understand who is truly making the big decisions. But when transactions do actually happen, the rules get very strict. Let's break down what must be disclosed. A company must report the exact amount of the transactions, which obviously shows us the size of the deal. They also have to show any outstanding balances and terms, meaning who owes money to whom and if that money is secured safely. And very importantly, they must show provisions for doubtful debts and bad debt expenses. Simply put, this means if a company gives a loan to, say, the owner's brother, and they expect the brother will never pay it back, they actually have to declare that loss openly to the public.
So, what kind of deals must be disclosed? The standard actually casts a very wide net here. It's not just about buying and selling goods. It includes renting offices through leases. It includes providing a guarantee for a loan. It even includes something called executory contracts, which is honestly just a fancy way of saying an agreement where neither side has actually done the work yet. It also includes management contracts, like deputing employees from one company to another. Everything has to be shared.
Now, a company might complain and say, hey, we have thousands of tiny transactions with our related companies. Do we really have to print 1,000 pages? Well, the standard is very practical. It says companies can group similar small items together in their reports. However, there's a very strict condition. They absolutely cannot club a massive, major transaction into a group of small items just to hide it from the public. Significant material transactions must always stand out clearly on their own. Moving to Section 4, Government and Privacy Exemptions. Basically, when the rules bend. Sometimes the normal rules of accounting have to adjust to the reality of how a country actually runs. In our country, we have many large government-run companies. So if 2 different companies are controlled by the same government, do they have to report every single tiny trade they do with each other? The standard gives them a slight break on the paperwork here. They are exempt from listing every tiny detail, but they must still disclose the name of the government, the nature of their relationship, and, most importantly, they must still disclose the amount of any individually massive, significant transactions. So transparency is definitely still maintained for the big numbers.
Another important exemption to note is how the standard respects the law of the land. The standard clearly says that if a specific statute or regulator prohibits sharing information, the accounting standard won't force you to break the law. The best example from the text is banks. Banks have a strict legal duty to keep your customer data private. This accounting rule will never override that privacy obligation, so your confidential data remains totally safe.
Finally, Section 5, Differences from Global Rules and how India's IND AS 24 stands out.
If we look specifically at Appendix 1 of the document, we can see exactly how the Indian rules are specially tailored for us compared to the global rules, which are known as IS 24. Unlike the global rules, our standard explicitly protects statutory privacy laws, just like we saw with the banks. For the family definition, our standard specifically includes brothers, sisters, and parents, recognizing the deep influence of the Indian family system. We also specifically added deputation of employees to the rules, because that's a very common business practice here. And finally, India added strict, clear wording to make sure companies cannot group transactions just to hide big deals. It's a very robust, locally tailored standard.
As we reach the end of this explainer, I want to leave you with this one provocative thought. Transparency protects everyone, from the biggest bank right down to the common man investing his small savings. These rules exist purely to give you power and insight. So, the next time you read an annual report, are you looking closely at the companies you trust? Are you checking the notes for those related party disclosures? You definitely should be. I really hope this session made a complex accounting standard very simple and clear for you today. If you found this explainer helpful, please hit the like button, share this explainer with your friends and family so they can be informed investors too, and please don't forget to subscribe to our channel for more content just like this. Thank you so much for learning with us today. Namaste and see you next time.